Alrighty, guys, welcome to another episode of the WealthWise Show. I'm your host, the Wise Investor, and today we're going to embark on a WealthWise journey of personal finance. And today's episode is kind of piggybacking off of last week's episode, and that was options, in particular, call options. So before I get into today's show, a couple of housekeeping things. Guys, remember that this podcast, myself, and this episode is meant to be educational purposes, or meant to be for educational purposes only. It's not meant to be enticing to go and implement some strategies, option strategies. This is not meant for you as personal finance. Please visit and see your own personal financial advisor. Please do not use this podcast or anything I say as, advice. It's not personal advice, guys. I think that covers it. This podcast is for educational purposes only, and I think that should be good enough. So let's get into today's show. I know last week I talked about a little option strategy, and it's something that it's not like a secret. It's not like, oh my goodness, I just broke the internet with something that no one knows about. Cover call options has been around since the beginning, so it's not like there's tons of videos out there. So if last week's episode was a little confusing, I'm going to try to clear up some of that confusion. But at the same time, you can feel free to go out and, look up other YouTubers who may have did call option videos, other, Investopedia, they have cover call options articles, and to get a better understanding. But today I really just want to talk about actually what are options, because I know I'm not gonna lie to you, there's probably like 4 of you who listen to this podcast every week, which I appreciate all 4 of you, including myself. So I'm part of the 4. And so I know maybe, the 3 who are not me, may not know what options are. They may just be like, hey, what is an option? And for you 3, since you guys been rocking with me since the beginning, which I really appreciate, I'm going to try to, clarify what are options. Great. We know about the strategy. You told us about, something about cover call options last week. What is an option though? How can I implement this into my personal finance? How can I implement this as making a part of, whatever goals I have? Me and my advisor, we talk about it. He's kind of busy, so he hasn't really explained to me what options are. So that's where I come in, just to give you a little history on them, and what they are and all that good stuff. So I have my outline here. So hopefully today's production is a little bit better, a little more concise, not all over the place. So basically what an option is, in the short term, I kind of explained it last week, but it's basically just a contract for the person who writes the contract to sell shares or buy shares at a certain time. And so if I wrote a cover call, I'm giving the, person who purchased that contract the right, not the obligation. You don't have to. The person, if you buy a option contract, you don't have to do anything. It's not like futures, but I give them the right to purchase my shares at whatever price. And then same thing, if I write a put contract, I give the person who purchased it the right to sell me their shares. So that's essentially, in a nutshell, what a option contract is. Now, some people might think, well, a contract, do I have to write it up? Do I need a lawyer? What do you mean contract? And in theory, you may be right. Contracts are legally binding agreements, typically. But in the case of option contracts, the broker, which is probably going to be, whoever you have your brokerage account with or whatever account you have, they do all that work for you. So it's not like something you have to write up. you put in an order to sell a contract, they make it all up and they sell it. And then the person who buys it, they don't have to sign anything because it's not an obligation. So it's not like, if you are writing it, yes, you do have to sell your shares or buy some shares. But if the person who purchased it, they don't have to do anything because you get paid a premium. So I'm putting the cart before the horse a little bit on that. But when you hear a contract, especially in the world of finance, they're derivatives. They're not like, like actual shares that you have. So when you hear contracts, kind of put it in the mind frame of, what's the word I'm looking for? I don't know the word I'm looking for, so I'm going to skip past it. So it is a contract, but not something super like, you're not going to get sued, because typically if your broker is the one who's doing it, it's going to happen automatically regardless. You're going to either get a margin call or, you have to put some money up. So, the way they have option contracts set up is where, the broker pretty much controls all of that. Give me 1 second because I am a little stuffy. I just gotta. All right. Sorry about that. So, I know that was a word cut, but it was mainly because I'm not sick. Yeah, don't worry. Don't stop playing the video. I'm not contagious. I have really bad allergies during this time of the year. It seems like every year around this time of the year, I'm recording this in January. I think it's January. I'm recording is February 5th. So yeah, I might sound a little nasally more than normal. I might pause a few times. You might be a little weird cuss here and there, but just know that, I don't want to sneeze in your ear because that's just disgusting. So basically, back to the options. Those are contracts. The broker handles all that stuff. So you don't have to worry about writing a contract out. You don't have to worry about signing anything. And understand that if you are a buyer of a contract, you don't have an obligation. And so you're not obligated to purchase or sell anything. You just have the right to do so. So that's why a lot of people purchase options. For example, if, I want to buy some shares of a company and I think it's going to do really good over the next couple of years, but I feel like, I don't want to outrightly go buy those shares. Well, I might buy an option contract on that company in hopes that, it's going to increase. And then I can exercise my right to buy those shares at a lower price. So let's say a company is at $100 right now. And I say, man, the company's at $100 right now. I think it can get up to $150, but I want to, minimize my risk, my exposure to this company because, yes, I feel like it's going to get to $150, but I don't want to outrightly buy 100 shares right now. So instead of buying, $10,000 worth of shares, I'm just going to spend, $1,000 to buy this option contract. And let's say it goes up to $150. You're like, oh man, I was right. $150. Now it's time for me to either exercise this contract or not. And I'm like, I paid the premium, the premium is nice, but I'd rather have the shares. So I will exercise the right to purchase those shares at $100. So now I have my 100 shares that I wanted of this company, and I paid $100 per share. So I gave them my $10,000, but because the share price is at $150, I just got $50 per share. So I just made $5,000 per share. And I get to keep the shares, and everyone's happy. The person who sold me the shares, you might be like, well, what about them? They sold me the contract, but there's ways around that. The cover call option, which I mentioned before, kind of alleviates that burden because in the process of me buying the contract, I'm giving that money to the person who wrote the contract. So it's not like they're coming off, in the hole. They're walking away with some money. And if they've done it right, they probably bought the shares when it was $50 a share. So selling for $100 a share, they might not get the full $100 move from $50 to $150, but they still got at least, the $50 move plus the premium, the $1,000 that I paid to get the contract. So that's pretty much almost the gist of how someone will utilize contracts to buy shares. And that's one aspect, that's call options. But we're going to talk about all of it, not just calls and puts. We're going to talk about all that stuff. And so here are my show notes. The definition that I wrote, I guess, a call option provides the right, but not the obligation to buy the underlying security, which is the stock or the index or wherever the security that has the option, and remember securities are, stocks, bonds, futures are not securities, but index options, ETFs, those are considered securities. So when you hear securities, just assume, some sort of asset that's regulated. So the underlying security at the set price before expiration. So I'm going to stop here at expiration. So these contracts, it's an option contract. They have an expiration date. That expiration date, is the date that, you can pick it if you want. And that date is where everything has to be, decided. So if I bought an option contract that expires, in 2 years, in 2 years time, if I decided I want to keep the shares or not keep the shares, if I want to buy the shares, then, I would then exercise my right to buy those shares at whatever the price, at that date. So when you have an expiration date, you have up until then to decide, if you want to either buy the shares, if you bought the call contract, or you want to keep the premium that, the contract made. And so that's, that's more of personal. That's not really has nothing to do with the explanation of what options are, but they do have an expiration date. And back to what I was saying, it gains value as the security price goes up. So call options, when the price of the security goes up, call options gain more money. The contract becomes more valuable. Remember what I said, if I bought a call contract or call option for a underlying security and the strike price is $100, meaning, the security, let's say the security is at $100 and I bought it at the money and it's $100. If that stock goes up to $150, well, that contract becomes more valuable now, because if I were to exercise that contract, I automatically get, $50 a share. And so that's why when the stock goes up, it becomes more valuable. And so it does have a limited upside potential because stocks can go up crazy amount. They could just keep going up. For a good example, GameStop. That is a company a couple of years ago where the stock was like, $2-3 a share, maybe $10 a share. And it went up to hundreds of dollars a shares. And so, in a short period of time at that. So if you held a contract, an option contract at, let's say, $10, now the share price is, $100, $200 a share. If you were to exercise that, you just made $90 a share. And so that's where, the stocks, if they keep going up, the more money that the contract will have. Now, the good thing about call options, though, is though they have a limited upside potential, they have a limited downside risk. So what does that mean? So remember, options are just the rights to 100 shares of wherever the stock is or what have you. So it's just a right. It's a contract. Even though it does fluctuate with the underlying asset, you're not buying that asset until you exercise that contract. So if I buy a call option and, it goes down, the market or the stock goes down, meaning it's losing value, I will only lose the amount I paid in premium. So if I paid, $1,000 for this contract, I'm only going to be losing $1,000. And so that's, why it's nice with some people you do the strategy because, the loss, how much you are willing to lose, that up front. It's not like, a secret. You're like, hey, I might lose, if I put up $1,000, I might lose 10. No, that might not be the case. Well, that's not the case because, you bought the contract for $1,000. So that's why options are attractive to a lot of people because the upside potential is unlimited and the downside potential is limited. So that's one of the reasons. Remember, the call options, you want to go up when you buy them. Now, there's another form of an option contract is put options. So puts are inverse. They're opposite. They're the opposite of a call option. So unlike a call option, put options grant the right, but not obligation, to sell the underlying stock at a set price before expiration. A long put acts as a short position, gaining value as the stock price drops. Protective puts serve as insurance, creating a price floor to hedge investor positions. So what does that mean? So, like I said, it's the inverse. So if calls means you want things to go up, gain value, puts are the opposite. So like when you buy call options, it gives you the right to sell, not buy. It gives you the right to sell the underlying security. And why would someone want to do that? So think about it like this. You're like, this company earnings last quarter was not that great, and this quarter, I'm hearing some stuff that I'm just not really liking. You know what I'm going to do? Instead of just selling all my shares, because, it is a rumor, what I'm going to do is I'm going to buy some put options. So when you buy a put option, let's say you buy it for $100 a share. The strike price is $100. And, you buy the $100 put option and you're right. I knew it. The earnings came in. It wasn't that great. Wasn't in line. The CEO got kicked out, whatever. And now the stock is in free fall mode. So what's happening now? Your shares that you own is losing value, because your stock is going down. So what you could do is with your put option is, I'm going to exercise my right to sell these shares at $100. So if the stock is at $50 a share and you exercise the right to sell those options or those shares at $100 a share, now you're not participating in that free fall. You're kind of like, you're even though you might have lost something, but you at least protected a good chunk of your invested assets when you do something like that. So when you think about puts, you buy it, the stock is going down and you want to protect yourself, you exercise at a higher price. And so that is basically the general way you will use options. With the call options, you have the stock, meaning you have 100 shares, and you sell the contract to someone, and they buy it, and now that person has the right to buy those shares, and it's a nice way to basically hedge. Not just hedge, but produce income, like I said last week, but really nice way to hedge or buy shares. If that, you're not 100% sure and you don't want to jump in, buying shares, you can just buy options in the money options and then exercise them later on. And, now you have a cost basis lower than you would have if you bought them at market. Same thing with put options. It's a sort of a hedge as well, to where it's like, there's uncertainty in this equity that you own. And instead of, leaving it up to chance that, you're wrong because you feel like that uncertainty may be the downfall of this particular company, then now you can protect some of your assets that you invested in that company. So those are pretty much the definitions of calls and puts. Remember, if you buy a call, you're going to be bullish. Bullish means you want the market to go up. Basically, you're on the upside. Hey, we're going up. And if you buy puts, you're typically going to be bearish, meaning, hey, there's uncertainty. You think it's going to go down. So those are the two differences between the call options and the put options. And the various reasons that an investor will use those is, like I said, I will buy a call option if I want to buy those shares, but at a lower price at a later date. And the inverse is if I want to buy a puts, I want to sell these shares at a higher price if it went down, at a certain date. So that's just a recap of what calls and puts are. And, I use some terminology in here, and I didn't explain it on purpose, but now that you guys stayed towards the end of the show, I will explain a little bit of what those terminologies are. So when I say strike price is literally just the price that you want to sell or buy at. So if you buy option contracts, and let's say the stock is $100 and you want to buy the stock at $90 a share, so you're going to buy the $90 strike option. That's pretty much it. And the inverse, if you want to buy a put option and you want to sell these shares at $100, well, you're going to buy the $100 put option. That's what strike price is. And the expiration date that's super self-explanatory. That's the date to where the option contract expires, and the owner of that contract has to make a decision whether they want to exercise those shares or exercise the right to buy or sell, those shares. And yeah, I think I covered it. So next week's episode, I'm going to go into selling the contracts, like writing them. I talked about buying this week, and I talked a little bit about selling last week and a little bit this week, but I want to go in more detail on being the option writer, being the person who sells the option to the buyer, and how that can be more advantageous. I'm not even going to try to repeat saying that word. Why it can be beneficial to a person who, wants to sell them instead of buying. Because buying, buyer options is really, really lucrative. I'm not going to lie to you. And a lot of people do it. But there is a lot of risk when it comes down to buying options, especially if you're buying them. And, if you're like the puts, for example, you don't own the shares, you're using cash secure puts. Or, you buying options, call options, without having the money to buy the actual shares that you buy the call options are. So some people do it in a way where they buy the option just to sell it. That's their goal, is to buy the option, the call contract, to sell it when the price is higher, to sell it to someone who may actually want those shares, and vice versa. Some people will buy puts just to, get the increase, get the capital gains from, the downcrease or the underlying stock going down. So that is super lucrative, but there's tons of risks. So on the flip side, where you will become a person who's actually writing these options, you're writing the calls, you're writing the puts, there's a little more level of protection that you can have when you actually own the underlying stock. So I'm pretty sure on the put in, I got that a little backwards. But I will explain it next week. So hopefully next week I'll feel a little bit better. And we'll see. And so that's going to be it, guys. I appreciate you guys tuning in to another episode. Hopefully you guys like the setup. I'm going to try to make it look a little bit better. I'm in my bedroom, and I don't have a green screen. And yeah, so we'll see. So I appreciate you guys listening to another episode of the WealthWise Show. I'm your host, the Wise Investor. And until next time, stay WealthWise.